What if you could take actions today that would allow you to save significantly more in tax-free savings during retirement? In today's episode, we're tackling a tax planning opportunity that's often misunderstood, but one that you could use to be taxed at lower rates now, potentially, and enjoy more tax-free growth until retirement. And that's the Roth conversion. And we're going through this by decades. So we normally talk to pre-retirees here on the channel, but today we're going to break it down for a couple different people so you can take advantage of these opportunities. But first, I'm Chad Smith, and I'm here with Allison Berger, and we're with Financial Symmetry, and we work with retirees across the country to help them plan their ideal retirements. So if you like these types of videos, you want to subscribe so you don't miss the next one. So as we jump in today, Allison, we did an episode back I think last year, episode 129, where we kind of went through the one thing you can do to speed up your retirement success. So as we get started here, Allison, why don't you break down what a Roth conversion is and how it works?
Sure. So with a Roth conversion, what you're looking to do is take money that's in a pre-tax traditional IRA or 401k today, pay tax on it, and convert it to a Roth IRA where it's going to grow completely tax-free and your withdrawals in retirement will be tax-free as well. This gives you a lot of flexibility, particularly in retirement. Roth IRAs are not subject to those required minimum distributions that traditional IRAs and 401ks are. Could reduce the impact of taxation of your Social Security income and even the premiums that you pay for Medicare. This is also a great strategy for people who are concerned about future tax increases or changes to the tax code that might be looming in the future. Allows you to go ahead and hopefully pay a low rate today and then have those dollars tax-free in the future.
So as we jump into our first decade or decades here, we're talking to teenagers that may be working and people in their 20s, because generally you're opted in maybe to a 401k with some of the part-time jobs you're doing or your first couple full-time jobs and move it around more often. So you might have some lower balances there, and that kicks us into these 4 L's you can remember of why this is a good time to look at a Roth conversion for you. The first one, you're likely in a lower tax bracket. Those are your lower earning years most of the time, so that's a good opportunity to take advantage of a Roth conversion because you are taxed now on that. The second one, lower account balances, as I mentioned, right? It might be just contributing for a short period of time while you're switching jobs, and it might make some sense to move that from a pre-tax to a Roth at that point in time. The third L is you have a longer time horizon. You're young. You got a lot of years left for tax-free growth in that Roth after you've converted the money over there. And then the fourth L is a lower overall tax hit because that money is taxed whenever you make that Roth conversion from a pre-tax IRA or a 401k. So a great time to take advantage of a Roth conversion, but you want to understand your situation as always. So if we move into the 30s and 40s, that gets a little more complex, right, Allison?
Yes, this is a time, it's a little more complicated. The tax liability could be higher. Lifestyle is becoming busier. Hopefully income is higher, but there could be some opportunities to look for a Roth conversion in these years as well. One could be if one spouse leaves the workforce or experiences a reduction in income that might lead to a lower tax bracket year. If you have very high income and you're not eligible to make direct Roth contributions, you could be a good candidate for backdoor Roth contributions, which are really a form of conversion. A conversion is going to have to take place as part of that process. Career changes or breaks in employment during this time period, perhaps a layoff. The other thing that we've seen very significant, particularly in 2020, was business losses. So a year where you or your spouse has significant business losses, you might even be able to convert a pretty significant portion of a traditional IRA to a Roth without paying any tax dollars. So those are some good silver linings of things that otherwise might be viewed as financial negatives. Another good one to look out for is if you were not able to convert some of those lower balances in your 20s and maybe still have some left over, if we experience a market downturn or a bear market, those asset values are depressed, and that might be a great opportunity to go ahead and convert a traditional IRA or an old 401k to Roth, pay a little bit of tax, and then that's growing tax-free coming out of the bear market when we're expecting higher returns.
Yep. So in your 30s and 40s there, you can turn negatives into positives, potentially with Roth conversions in those years. And we have a checklist you can download. Should I make a Roth conversion? It's a kind of yes or no, and it'll take you along the map, a decision map. You can download that with a link that we'll have in the show notes below. So as we move into the 50s and 60s, Allison, we also have a video that we had put together a case study on this. Should I make a Roth conversion? You can search here on the channel, or we'll have that linked here in the video. But once you walk through a couple opportunities there in this time period.
Yeah, I would say this is our traditional retirement tax window where we're getting here. And in your 50s and 60s, this is really crunch time. It's time to be getting serious about those last final working years where you're really contributing, hopefully maxing out those retirement accounts and figuring out your retirement distribution strategy. As we're walking through the 50s and 60s, there might be some pretty significant opportunities for Roth conversions. One would be an early retirement. Either you or your spouse, income could decline significantly, leading to a much lower tax bracket. A layoff could also be a potential opportunity if you have a year or two break from employment during that time. And just as we saw in the 30s and 40s, potentially business losses that might be able to offset some of that income on your tax return and be a great opportunity to pull some money in at a low tax rate, and that can grow tax-free from there. This demographic, I will say, in these 2 decades, there's also a lot of pitfalls, and we detail those in a lot more detail in our podcast. So be sure to listen there if this is something that you're considering. You want to make sure you look out for those pitfalls and caveats and don't fall victim to something you don't expect.
Yes, many opportunities here for Roth conversions, but very important to understand that scenario planning. And as we talk in most of our videos, meeting with a financial advisor to run through different projections, different scenarios in your own life can make the most sense for you when implementing some of these decisions. Allison, all right, we're moving on up the kind of age chain here in our decades, and you get to your 70s and your 80s, and you think you might have missed the window for that Roth conversion, but there's actually some opportunity here as well, right?
Yes, I would say traditionally you might think the window has closed. You know, we're into receiving full Social Security benefits. We need to take our full RMDs every year. I don't have that much life expectancy left to benefit from that tax-free growth. However, Roth conversions in this phase of life are more likely to benefit your heirs. So these might be viewed as a gift to your beneficiaries to move some of that money that would otherwise be taxable to them to tax-free. So some opportunities to look for, we saw a big one in 2020, was if we get an RMD holiday. For 1 year, perhaps the IRS waives the RMD requirement. That may be a great year to pull some money in, convert to Roth IRA, get that into a tax-free account. Bear market as well. I would say this is kind of a double whammy here. If you can get the combination of these two, an RMD holiday with a bear market, then you're making those conversions at depressed asset values. Really great tax savings in that scenario. Even for retirees who might be charitably inclined, if they want to donate a portion or all of their RMD, that would open up potentially another window for them to do more conversion, paying tax on it now. You might also want to go ahead and take advantage of married filing joint tax rates as long as you can, because we know typically there's going to be one surviving spouse, and then at that point you could be subject to higher tax brackets because you'll be looking at those single tax tables versus the married filing joint, which are a little more generous.
Yes, so as you can hear, there's opportunities in every one of these life stages. It's important to recognize when these life transitions create opportunities, but you want to analyze it to assure that you're not paying at your highest tax bracket on these Roth conversions potentially, right? Because it's the lifetime tax rate that you're most concerned with here, comparing today's tax rate to the tax rate down the road. Also, the time frame you have for that tax-free growth matters. And then you can also share this with maybe a loved one, a child, if you're watching this video that is working in their younger years and can take advantage of those 4 L's. Lastly, of course, reach out to a financial advisor. We're happy to talk with you if you are interested, or there's many others across the country we could connect you with. So otherwise, you can listen to many of our videos here, watch many of our videos here, listen to many of our podcasts at financialsymmetry.com, and check out many other detailed articles that we have there, if that is your pleasure. You can subscribe over here so you don't miss our next episode, and we'll talk to you again in 2 weeks.